This is Raquel Rose, Group 1, Video 2 on Chapter 13. So for question 1, sustainable income is what a company's income will be in the future. Quality of earnings are the financial reports that provide full and transparent info that will not confuse or mislead the users. Question 2, horizontal analysis is a trend analysis of evaluating financial data of a company over many periods of time. An example of this is current year minus base year divided by base year. So 2020 minus 2015 divided by 2015. And then you also use the change per base period, or the current year divided by the base year. So 2020 divided by 2019. And then you also will use the vertical analysis, aka it's known as the common size analysis, which is a percent of a base amount, which is any asset divided by base, which is the total asset, or any liability or stakeholders' equity divided by base, which is total liability and stockholders' equity. The third is the ratio analysis, provides clues to underlying conditions that are not obvious, that we need multiple ratios to be meaningful, so you just can't compare one ratio, you have to use many. And then you have the intra-company comparison, which compares year to year. Then you have intercompany, which compares different divisions within a company. And you have the industry average, where you compare the median industry ratios to your own company. And then you also have earnings per share, which is net income minus preferred dividends divided by weighted common shares outstanding. And so you use earnings per share to evaluate a company's relative performance from a stockholder's perspective. Another ratio is price-earning ratio, which assessment of a company's future earnings, and you would get that by market price per share divided by earnings per share. Liquidity ratio measures a firm's short-term ability to pay maturing obligations and meet unexpected cash needs. And there's multiple liquidity ratios: working capital, current ratio, inventory, days in inventory, accounts receivable, and average collection period. And then the last solvency ratio measures of a company to survive over a long period of time. And the three different ones are the debt to assets ratio, times interest ratio, and free cash flow with their corresponding ratios. So total liability divided by total assets, and for times interest is net income plus interest expense plus interest tax expense divided by interest expense. And the free cash flow is net cash flow provided by operating activity minus capital expenditures minus cash dividends. And then you can use profit ratios. So these measure the income or operating success of a company over a period of time. And there's a few different ways to do this. So you can use earnings per share and price-earning ratio, gross profit rate, profit margin, return on assets, asset turnover, payout ratio, and return on common stockholders' equity. Thank you.